Everyone is arguing about the wrong part of Intuit. TurboTax is 25% of this company, and it's the only part anyone talks about. The other 3/4, QuickBooks, MailChimp with 8.9 million paying customers, grew 6%, then 5%, then 3%. And that slide started in 2024. That's before anyone even said the word AI. For the half, nobody's arguing about. At today's price, Intuit is valued as if its free cash flow grows at 2% a year. Not next year, every year for the next 5. And after that, never better than 2% for the rest of its life. That's not my forecast. And it sounds too extreme to be real, so let me show you where it comes from. At $345 a share, the market values Intuit at about $94 billion. When we take the free cash flow the business actually produced last year, discount it at Intuit's own cost of capital, 9.9%, and assume that after 5 years, the company will grow at a terminal growth rate of 2% a year, which is slower than the overall economy. With these assumptions, the current price implies that the company will only grow at the same 2% for the 5 years before it too. Intuit's own guidance for the fiscal year is 9 to 10% revenue growth. That's the number the company published itself. So the company says 9 to 10%, but the price only says 2% for 5 years. The business itself grew by 14% in the last fiscal year that they just closed in July. So one of two things is true. Either the market is wrong, or the market knows something about the next decade that the guidance doesn't cover. Every analyst I read has the same answer for what that something is. Not a spread of opinions. The same answer from 6 different banks inside of 10 weeks. It costs about 12 cents of compute for an AI model to process a tax return. Goldman Sachs estimated the number in a note on June 2nd and then put a sell on Intuit. Their analyst, Gabriela Borges, cut the price target from $519 to $276 in a single move. So the whole argument is a cost gap. Goldman puts TurboTax at about $162 of revenue per paid return. And this directly competes against the 12 cents of AI compute. Their base case has 20% of US tax filers moving to AI-only preparations, and TurboTax revenue landing 18% below last year by 2030. And the thesis deserves respect because it isn't imaginary. TurboTax units are already going backwards. 39 million US returns last year, down 2% in total. Management even said it on the last earnings call. In their own words, they lost quality DIY customers to lower cost alternatives. Last year, Intuit also reported total units down 2%. But paid units, the one that actually generate revenue, grew 6%. They were losing free filers on purpose, and they even said so. This year, though, they didn't publish that paid number at all. Not in the release and not in the earnings call. The one measure they reassured investors with last year is simply gone. I am not going to tell you what that means because I frankly don't know. Companies drop metrics all the time for boring reasons too. But it's the most flattering number they had, and it disappeared in the year they told us that price is why people leave. So the bear case has a mechanism, and now it has something it didn't have last year. A number Intuit stopped publishing. But there is one line in the Goldman Sachs own note that made me think. TurboTax is roughly 1/4 of Intuit's revenue and operating income. The bank that cut its price target for the stock in half is telling you that the thing it's afraid of is 1/4 of the business. So the entire drawdown, about $140 billion of market value gone, is priced off one line that still grew 7% last year. So that leaves two possibilities. Either the market is punishing the whole company for just 1/4 of it, or there's something in the other 3/4 that nobody's talking about. I went looking for the second one. In the earnings call, they mentioned 8.9 million total online paying customers, up 3% compared to last year. And the definition is the whole point. Intuit defines it as QuickBooks Online customers, QuickBooks Time customers, MailChimp paying customers, and standalone subscribers. TurboTax isn't in the list. So this number has nothing to do with tax. It's the small business part of Intuit. The part nobody's arguing about. And it's the part that slowed down. It also isn't just one bad year. Intuit only started publishing this metric in 2024, so there are 3 years on the record. Every one of them counts. Customers up 6%, then 5%, then only 3%. Revenue per customer over those same 3 years first moved 11%, then 14%, then 15%. So the volume growth is down every year since 2024. But the price is up. And the online ecosystem revenue? 19 to 20% growth in all 3 years. So it barely moved. And that's exactly what makes it so hard to see. The top line looks identical while everything underneath it inverts. From a business that grew by adding customers to one that grows by charging the customer it already has more money. And it all started in 2024, even before any of this AI argument existed. So the real question isn't whether AI eats TurboTax. It's why the other half started slowing down and whether that's QuickBooks. But in the earnings call, they stated that US QuickBooks Online customers grew 6%. That's double the blended 3%. So the core accounting business is growing at twice the rate of the number that scared me. That's a real reversal. QuickBooks in the US is not falling apart. And they specifically mentioned that it's US only. So international, it isn't. And excluding self-employed. So the cheapest tier is carved out. And it's also a growth rate, not a count, which means there is nothing to check it against. So that is the most flattering way they can cut this number. If the global figure including self-employed would also have been 6%, they would have just said 6% period. But I don't hold that against them. Every company presents its best cut, and 6% is a generally decent number. But it means the gap is still sitting there, and something between US QuickBooks at 6 and the whole ecosystem at 3 is growing a lot slower, or even shrinking. You also don't need anyone to tell you how Intuit themselves feels about the 6%. You just have to look what they did on August the 1st. Because on that day, Intuit raised the price of QuickBooks Online. Plus, the tier most growing businesses sit on went from $115 a month to $140. Advanced went from $275 to $340. Essentials $75 to $85. Only the entry tier wasn't raised. But across the tiers that did move, that's about a 20% increase. The 1st of August is day 1 of Intuit's fiscal year 2027. So this lands inside the exact year management has told us is all about winning customers back. And remember what they said about the other half of the company. Price is the number one reason customers leave TurboTax. Their own words. And then they go ahead and increase the price of QuickBooks by 20%. The part that took me longest to see is what that does to the guidance. Because a 20% list increase doesn't all show up. Some customers are grandfathered, some are discounted, and renewals spread across 12 months. After all of this, I'd expect maybe 9 to 13% of extra revenue per customer landing next year. That's way below this year's guidance and way below the revenue increase from last year. Now, what did Intuit actually guide? Global Business Solution, excluding MailChimp, grew 18% last year. This year, they guided 13 to 14. That's a deceleration. In the year, they are pushing through a 20% price raise. There are only 2 ways that works out. Either volume contributes close to nothing next year, or management already expects that the price raise itself will push customers out and has already built that into the number. But both are the same problem, wearing different clothes. Which leaves one question I still can't answer, and one date when it actually gets answered. But before we go there, if you're getting something out of it, subscribe. I publish up to 2 of these videos every week, always with a focus on the filings and not the headlines. And if you hold Intuit, what would make you sell? Not the price, the growth number. Put it in the comments because I'll be watching the same thing. But back to the question I can't answer yet. 6% growth in US QuickBooks, 3% across the whole online ecosystem. That gap has to come from somewhere. There are 4 candidates, and Intuit hasn't told us which. MailChimp, which sits inside the customer number and is guided to shrink next year. QuickBooks Self-Employed, the cheapest tier, carved out of the 6%, or International, which isn't in it either. And then we also have QuickBooks Time. If it's mostly MailChimp, this is a non-story. MailChimp is about 6% of the revenue and everyone already knows it's struggling. So it's already in the price. If it's QuickBooks outside the US or the self-employed tier bleeding out, that's a different conversation. That's the franchise. I can't tell you which, and neither can anyone else, because the disclosure doesn't exist yet. But it will. Intuit usually files its annual report in the first week of September. That filing carries the customer and revenue per customer breakdown, and it defines the metric, including whether they've changed what counts, now that MailChimp is being split out. So here is what I'll do. When the filing lands, I'll put the answer in a pinned comment below this video, including a link to the filings, whichever way this goes. Because if it says that QuickBooks volume is fine, I want you to see that too. But there is one more thing in this print that almost everyone got backwards. When Intuit guided next year's earnings, the headlines said they'd missed by 16%. But they hadn't missed at all. Intuit and the analysts were measuring with 2 different rulers. Because on the 1st of August, the company changed how it calculates adjusted earnings. It used to strip out stock compensation. Now it doesn't. That's $5.81 a share of costs that used to be excluded and suddenly aren't. So the company guided $22 to $23. The analysts were sitting at $27.30 on the old measure. But if we put the stock compensation back, the guide is $28.70 to $28.90. And that's above consensus. That doesn't make the sell-off wrong. The revenue guide was really disappointing. 9 to 10% against 14 delivered. That part was real, but the earnings collapse wasn't. And now the other direction, because I said I'd come back to this. Intuit's reported free cash flow was $8.6 billion, but that's distorted. About $1.3 billion of it came from a tax change. Real cash, but a one-off. Strip this out and you get $7.3 billion. And that's the number I used for my DCF at the start. And look at next year. The forecast is $8.3 billion, lower than this year, even though earnings are guided up more than 20%. That's the tax benefit not repeating. The analysts have already taken it out, so I am not making an adjustment nobody else makes. And there is also a mirror image of that in the earnings line. This year was depressed by a restructuring charge, so next year's growth looks bigger than the businesses. Guided up 22 to 24% on revenue, up 9 to 10. And most of that gap is the charge not repeating, plus a 70% headcount cut from earlier this year. And the research for the video also showed me a real bug in the system. Because if you pull Intuit's forward earnings on most research terminals right now, you will get a number on the old non-GAAP definition sitting next to the history on the new one, as this shows here. So be careful which numbers you use. Almost nothing on the front page of this report means what it looks like. The miss that wasn't, the cash flow that doesn't repeat, and the earnings growth that mostly was a cost cut. So, as I just said, for my discounted cash flow, I used a free cash flow of $7.3 billion as a base case. The cash flow that repeats, not the one that got flattered. I also used a 5-year growth rate of 9%, which is the company's own guidance, and discount this at 9.9%, which is Intuit's own cost of capital. After that, the growth settles to a terminal growth rate of 2%. And that gives a fair value of $461 a share, against $345 today. But the most useful part isn't the fair value. It's the sensitivity table, because that tells you how wrong you can afford to be. And in this case, you'd have to cut the growth assumption from 9% to about 2% before the fair value drops to today's price. which is essentially the same thing the reversed discounted cash flow told us at the start. Today's price assumes a 2% growth rate while the company is guiding 9 to 10. The most bearish note on the street models about 6% group revenue growth. But we also need to look at the downside, because that's the part that decides whether you can own the stock at all. And for that, I would assume a growth at 3% instead of 9% and a discount rate of 12%. That reflects a barely growing business with a franchise under real attack. And the price for that is $286. So the question is whether that's what the business actually looks like. And to find it out, every company I look at goes through a scoring system I built. Same metrics, same weights, applied identically to everything. I built this so I can't talk myself into a story. Intuit scores 7 out of 10 on 5-year data, 7.4 on 10-year. The number that drags the score down is the value and momentum score with a 4. And 2 of these are worth a closer look. First, the quality, because that's what this whole video has been arguing about. The narrow mode scores a 7, and so does the 8.9% secure growth. Customer concentration is a 10 out of 10 because nobody here depends on only a handful of big accounts. Manager quality, 7. So the system doesn't see a broken franchise. But then we have the valuation and momentum. And that's interesting because it isn't really about the value. What actually drags that score down is the momentum. 12-month performance minus 44%, 1 out of 10. And it's sitting in the bottom quarter of its 52-week range, 2 out of 10. So the weakest score on the company is weak exactly because the stock fell, which is what I wanted to explain. So 7.5 on quality with an implied growth of only 2%. Those are all true at once and they don't point the same way. The business is good. Not flawless, but also not a company coming apart. But the price today assumes it stops growing. That's the entire bull argument and it's why I am here at all. So even though this is not a buy and forget stock for me, the upside is too good to ignore, so I have just started a position in them today. It is still deliberately small because there are 2 things I am watching that would change my mind. The case against me is the 10K for 2026 that will be released days from now. I am looking to see if the slowdown is QuickBooks rather than MailChimp. If QuickBooks shows the first cracks, everything I've just shown you is worth less than I think. And the case for me shows in the next earnings report in late November or early December. That's when the first quarter with the price increase closes. If customers absorb 20% and stay, the pricing power question is settled, and today's price could start looking like a gift. So there are 2 catalysts, and the first one is just days away. Now, if you've got something out of this, subscribe. I post up to 2 of these every week. And if you think I've got this wrong, let me know in the comments. And when the report lands, I'll pin what it says there either way. And if this was interesting for you, IBM did the same last month. The stock crashed 25%, but everyone watched the wrong number. The video is on screen here. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.